my pleasure to introduce the first presenter today, Eric Offenberger, CEO of Vext Science. Vext shares are traded under the ticker symbol Vext on the Canadian Securities Exchange and VextF on the OTC Exchange. We have research coverage on the stock where we have a speculative buy rating and a $2 price target in Canadian dollars. Vext is a leading business in the Arizona market. It produces and distributes vape and branded products, and including concentrates, edibles, and distillate cartridges that are sold in more than 100 of the state's active dispensaries. Its Herbal Wellness Center branded store locations are some of the most productive stores in the state, with ample growth opportunity as Vext continues to lean into the recently approved adult use market opportunity. Finally, the company has partnership structures in several other states, most notably Ohio, where it has achieved distribution of its branded product portfolio to most of the state's dispensaries, as well as where it holds a JV partnership with a retail licensee. With that, I would like to turn the call over to Eric to discuss the business of Vext Science and the growth opportunities in front of it. Eric, over to you.
Thank you, Andrew. Thanks for having us. Vext, trying to get to the deck here. Andrew, I don't see Caroline's deck. There we go. Thank you. So, Vext Science was established in Arizona. We have operated profitably in Arizona since 2016. As Andrew mentioned, we have 2 dispensaries in Arizona. We have the management team. We've been operating in Arizona since 2013 when it first went legal. We have 2 indoor grows, 1 outdoor grow, the manufacturing plant, and we've recently announced that we're going to be expanding our indoor capacity to Eloy. As Andrew mentioned, we have 5 additional states we operate in under a JV model, primarily with Ohio as the focus. We're well capitalized at this point for everything on our growth strategy at this point is done. We have insider ownership of 35.9%. We're going to skip the next slide. So on us, what we think of in the marketplace and how we've identified states that it made sense for us to operate in and be a little deeper was we've always looked at decriminalization as what we think is going to happen. I know there's a lot of conversation about safe banking or where it's going to go. We happen to believe that it'll be safe banking, that it won't be full legalization. With that said, we continue to believe that the focus in Arizona, Ohio, those states with the limited license is the best use of our capital and the best opportunities for our shareholders. Vext Science, oops, went the wrong way, excuse me. Okay, sorry about that. So when we talk about Arizona, as Andrew mentioned, Arizona's got the adult use. I know some of the other panels have operations here too. The Arizona market continues to grow. We anticipate it being $3 billion in 2025, so it's got a long way to go. The other nice thing about Arizona is our medical patient base continues to grow. In addition to, we expect that the tourism season, the snowbirds this year will be a lot greater as COVID is tapered off in Arizona in particular, that we think we'll have a lot of visitors. The thing we like about Arizona is it's a limited license state. At this point in time, there's 143 dispensaries approved. Part of those are the last group that went out for 12. And what that does to us is it gives us 2.2 per 100,000 for licenses currently contemplated. As we talked, Arizona is a vertical integrated state. So we have cultivation, manufacturing, kitchens. We have the full range. There's going to be an additional 26 licenses that will be issued under social equity. We don't anticipate those to really be come into the marketplace until later in 2022, 2023 timeframe. Continuing to work on limited license states. Here we're contrasting why we like the limited license versus like a state like Colorado that's a lot more established. If you look at the dispensary count, it's a lot higher in the state of Colorado to Arizona. We think that provides a better opportunity for us to realize a return on our capital and have a better margin protection that will continue to increase as we keep going forward. It also means that with vertical in the state of Arizona, it's a lot more of a capital upfront cost, and that the ease of entry obviously is controlled by the legislation. Sorry. This is how we've structured Vext within Arizona. Arizona still operates under a not-for-profit model. Because of the Vext with the JVs, the revenue that we generate or show is all based upon what we do in Arizona. So with the not-for-profit model, we have certain levers or abilities to generate income off of Arizona and support the not-for-profit. So you'll see management services, professional services. You won't see the traditional sales to the end customer. As Andrew mentioned, our wholesale business is significant, but again, those sales are reported up underneath the dispensary, which we do not have. We have a management agreement to support. And then what happens is then we do that and the subsidiaries pay back the cash as we incur expenses. This is a picture that shows the existing facilities. One of the opportunities that we have in Arizona is we've been limited to 2,000 square foot dispensaries. In the adult use legislation, Phoenix is allowing us to go to a 5,000 foot. We believe that our existing real estate that we control and own and is on the balance sheet will provide us the opportunity to expand that footprint. The center slide showing the existing dispensary that came in 2013. We own both of those parcels. We're working right now with the city of Phoenix of how to join them and expand them. That's one of the ways we think we can continue to grow and take advantage of a greater customer base. When we look at our canopies and what we've done for the expansion, in Phoenix, we have 11,000 and 9,000 in Prescott at our total of 20,000. On Prescott, we also have about 10 acres on outdoor. And you can see on the right some of the pictures of the indoor and the outdoor there. When we fully expand by the end of Q4, we'll be at 13,000 in Arizona, in Phoenix, 11,000 in Prescott. And the Eloy facility will be 34,000. It's a 72,000 square foot building. We anticipate having that fully built out by June, July of next year, and fully operational by the third or Q4 where it's producing. Our manufacturing is in the Phoenix complex, and we recently opened up a new facility there where we've expanded our capability, increased our overall space, and improved our operations significantly. That's really allowing us to take and get some equipment efficiencies as the market expands and it becomes a different customer base. We've recently announced ventures with Source for the major brand in Arizona and Wink to bring in the Wink brand into Arizona. Both of them use Source technology and a nano and are highly rated in the beverage category. We think that's going to continue to enhance us and have vape and brands be fully built out. This is a look at some of the products we're doing in our packaging. This talks a little bit about some of the reasons we've been able to grow, and the brand strength has been very well for us, and that's what's helped us in the other markets for the JVs. If people have recognized the brand and reached out to us in states when they've gotten a license to say, you know, we've got this cannabis license, we really don't know that much about the industry, but we'd like to form a relationship. That's been one of the drivers that's helped us. So our return focus has been always on profitability and what we're returning. We like to look at our cash flow from operations. We think that's in the higher levels within the cannabis space, and we continue to focus on that. We also looked at it from the standpoint of how could we expand without having to have a deep capital and not outrun our human capital. This is a list of how vaping's currently, or Vext is currently operating in the different states. Financial performance. So far this year, we're at 18.5 through the second quarter. We continue, as we mentioned, on the adjusted EBITDA continues to run exceeding where the analysts have predicted it for us. So we continue to perform in the way we'd like. This is a list of the board, and that's what I wanted, the share structure. So Vext, like a lot of US companies that are traded in Canada, we have the super voting shares in order to maintain the foreign private issuer status. So once we're fully diluted, it's at 175 million on a fully diluted basis. We talked about insider ownership has about 36% of our shares. We continue to look at different opportunities for the Vext brand where it makes sense on the M&A front, and see how we can continue to grow the portfolio and make sure we're doing the positive operating cash and the return on investment. Highlights, as we mentioned, we think Arizona is going to continue to grow. We've been operating profitably since 2016. We have the 2 dispensaries. We got the 5 additional states. We have the cash on hand to do the build outs we have planned, and we have good control of our shares. With that, I'd like to talk a little bit about Ohio. Ohio is the state that we're focused on in addition to Arizona. We have the retail presence there. We're in process of trying to, we have an appeal that's out with our joint venture for the cultivation. We think will be exciting, and that'll come to fruition for us in the near future. And then we can be vertical. We also know Ohio has the opportunity for expansion of additional licenses coming up. We will be participating in that. We would like to continue to grow in Ohio. We think Ohio and Arizona are going to behave very similar, and that we have know those states well. So that's what we continue to be the focus. Okay, Andrew, I'm up for questions at this point. I'm sorry about my presentation skills on the slideshow.
No, you did a great job, Eric, going through so much detail so quickly. We really do appreciate that. I'm happy again to kick off Q&A. Just a reminder to our audience, they are able to submit questions through the Q&A function on the Zoom webinar, as well as through the YouTube live stream. So first off, Eric, I wanted to ask on the performance of your stores in Arizona. They've clearly been quite strong relative to the state average, well ahead of peers on a per store basis. I'm just wondering, what were the keys to success there? And do you believe that Vext can replicate that success at the store level as it moves to new states such as Ohio?
Yeah, I think the key, obviously, the number one key is that we've been fortunate with the team that we've built, and the staffing's been done very well. We also, with Arizona being vertical, we also were very cognitive that we had a lot of brands in our store, not just our own brands, but we had that variety for that customer base. And then that said, we recognize the demographics. So our first store is in a very urban setting, heavy medical patient. It's not, it does some adult use, but it's not going to be as significant as the medical because that patient base does not have the income and they're not going to want to pay the differential on the sales tax. So we were fortunate with that store that it's always been there. It's a consistent buying base. It's always had a consistent customer base and loyalty. The new store that we moved in July of 2020 that we relocated when we had the opportunity to do the RDF or the organic acquisition, it's located more in an area that has some suburban setting, and we're seeing more adult use there. So I'd like to say by blind chance, we've been able to position our store so that it takes advantage of that. We do think that that's going to translate into other markets such as Ohio, because we've been able to go into the Columbus market, which has the highest patient count within the state, which is Franklin County. And our store is located in an area that's close to the university and has decent traffic, that we believe that that's going to continue to happen. What we're seeing in a lot of the stores is most of the customers are like typical retail customers. They're coming within a 5-mile radius of their store, especially as a market gets more mature like Arizona. You have a lot of stores that are competing. Customers now start to drive to those stores. They don't have to drive like in the early days in 2013 when we were the second dispensary open in Phoenix. If you wanted cannabis, you had to drive. Now that's no longer an option or a necessity for people, and they shop where it's convenient for them.
Great, thank you for that. I also wanted to ask, of all the joint venture opportunities that the Vext has and the various, state footprint, you're clearly spending a lot of time and focus on the Ohio market. Could you share your thoughts on Ohio and why this state in particular, and what you have on the ground in the state, why this may become increasingly important for Vext as an area of growth over time?
Well, Vext was started, we did things as a bootstrap. So we built the company based upon what we could afford at the time, and we expanded. When we looked at Ohio and got involved with Ohio and our partners there, it continued to look like Arizona. So it had 60 licenses, it limited it to. It wasn't vertical, but it had all those elements that made it so that if you made an investment there, you had a chance to get a return on that investment and generate cash flow. When it expands, it'll go to 130 licenses. It's got a population of roughly 12 million. It's got 4 nice metropolitan centers to work off of, so that we keep thinking that it's going to be, we just keep thinking it's going to keep growing. Since we've gotten the retail, we've got the manufacturing, and we are optimistic that the joint venture will receive permission to do a cultivation, which will be the 25,000, the big cultivation. It'll allow us to be vertical there. We are identifying locations to apply for new licenses for the stores. And, we're hopeful that we will receive a couple more retail locations so that we can have that built out and support it. The vaping brand's been accepted well out in Ohio. There's current common customer base there that we see in Arizona or see in other markets. So it's been consistent. And I do think Ohio will go recreational and adult use relatively soon. And hey, how can you pass up 12 million population with 130 stores? It's a great opportunity for us.
Absolutely. Which brings us to my next question here. Looking at Vext, if you had, an additional $15 million appear in your bank account today, how would Vext be looking to spend that, to deploy that capital? Where are the best opportunities in front of it to be able to grow the business?
Well, right now, with Ohio granting the licenses, Ohio only has about 4 licenses that are not already affiliated with somebody that's an MSO. So your opportunities there are limited on acquisition, obviously. Arizona has more. So I would say your best bet would be to deploy the capital into Arizona. You would like to try to find somebody that would fit into your culture, fit into your environment, that you could expand on an M&A front. I don't know if you'd be able to do it with 15 million, but that's where you would look right today.
That's great. Thank you, Eric. I've actually had a question emailed to me, and it was a good one. You've announced 2 recent agreements on the beverage category. We would just like to get your thoughts on what you think of the beverage category, how it fits into your overall plans for the business, and whether you think it's going to become a meaningful contributor to Vext's overall top line within the state of Arizona.
I think it'll be a little bit slow to get started to it, and primarily in Arizona because of the limitation on the square footage that a dispensary has. So one of the advantages we have is we have built out our distribution and we have an established distribution, so we can do more frequent deliveries. That said, I think beverage will be a niche. I think in an adult use market, it has an opportunity for growth. What we were able to do is shortcut some of the development. A lot of beverage has a problem with the emulsification around the THC, and it separates, makes the consistency or the testing or the dosing not as accurate as you want. The other thing it does is it tends to make it more difficult on the flavors. Major is the #1 seller in Washington. It does very well there, moves a lot of units. In other states that Major's been in, it's a similar thing. So they've got a great profile on that flavor. We'll be bringing Major to Ohio also. With Wink, what it does is it's a low calorie seltzer that's a microdose. It is great for a lifestyle thing of recreational, a tourist that wants to have some THC, but doesn't want to have a heavy dose. This is a microdosing. It's got the effect relatively fast, within 20 minutes. It's got onset. So somebody that's wanting to do it in a social setting or use it as a tourist or something along those lines, or take it to a party, to take the edge off, it's a perfect product line for that. What it did for vaping is we call it vaping brands. So what it did for the brands is we've got the extracts, the concentrates, the edibles, the infused products. It now gave us a beverage. So one of the things I think is going to happen in the industry is, like any other industry, is you start looking at opportunities to minimize your cost, maximize your return. One of those is to reduce your vendor base. So as vaping's continued to be in the marketplace, we think it helps us with giving somebody a full selection that, one vendor, one invoice, one delivery, and we can help supply your product categories you want to stock. So that's what it did for us, is it completed the brand and it gave us product that was of the same type of quality that we'd always expected with vaping, that we didn't have to try to develop it in-house to get that proprietary technology.
Great. Also, another question on your production capacity in the state. That having tripled or moving towards tripling by the end of this year. Just want to ask on how you will be allocating that incremental capacity between your own store network and the wholesale market opportunity, and how material of a driver is the Eloy facility and the expansions you have made at your existing cultivation facilities as well?
Well, the increase in the production capacity gives us obviously two different paths. One, we can do wholesale flower, which we've never done before. We will consume the balance of that, and again, of what Eloy comes up on production, into our own retail spaces. Currently, we buy a lot of wholesale flower in order to meet the demand that our production can't keep up with. But once we bring everything on board, we will have excess and we'll enter into the wholesale market, or ideally, we'll find another independent party that it makes sense for them to be part of Vext, and then we can support that additional retail growth. That's the ideal, but either way, we're well positioned that we can consume it and maintain the margin.
Great, and appreciate how quickly we're getting through all these questions. I think we got time for perhaps one more. And on that, I would like to ask on the transition of licensing. You currently manage the operations of your two Arizona license holders. You guys have stated publicly that you would like to consolidate those businesses by the end of the year. Could you walk through that process and how that could be potentially a catalyst for the stock by year end?
Well, because we are focused on Arizona and that's what we do and what we see, it's a little bit more challenging from an investor standpoint, and particularly I think for a retail investor to really understand the structure and how the levers work that you're pulling the cash out of the not-for-profits and that structure. So I think when you can go to a for-profit basis of managing them, then it will be easier for the investor to understand the statement, and it'll be easier for them to do a comparison, and they'll understand it better. From Vext standpoint, it obviously reduces the complexity of the situation. So it's a straight business thing on the corporate level. The way the structure will work is, even though the dispensary is not for profit, from a federal income tax standpoint, it's a for-profit organization. So you're really just going to switch the membership owner from the board of directors that's on those dispensaries currently to the ownership of Vext, and it will still file its own separate tax return. But from an accounting standpoint, it'll be considered a consolidated entity at that point in time where Vext has the ownership. It'll give us a lot of other opportunities too, I think, of again, based upon how we have to pull the levers and stuff for sales, we're normally behind the dispensary in a sales standpoint. It'll make that more transparent. You can do better stuff with your cost structures and stuff.
Right. Well, Eric, thank you so much for joining us here today. Your insights on the Arizona and Ohio markets are really appreciated, and into Vext as well. Again, we continue to cover the company with the speculative buy rating and the $2 price target, and is one of our favorite names in the US cannabis sector. So thank you very much, Eric, for joining us here today.
Thank you, Andrew.
Anytime.
Bye-bye.